Hi, friends. Ted Green, Spartan Investment Group. Monday, September 25, 2023. I hope you had a great weekend. Bond market volatility is poised to move to an all-time extreme as options for the 10-year government bond currently have a net speculative short position of over 750,000 contracts. And this is courtesy from data from the CBOT, Chicago Board of Options Trading. And this is virtually unprecedented. This is the biggest trade. This trade is lined up in the biggest volume ever. The Bank for International Settlements, which manages funds for international banks and encourages cooperation between countries across the globe, is warning that if hedge funds get squeezed on this trade, and by the way, they frequently lever 50 to 1, they could be forced to sell their positions, which could significantly move prices. Now, back in April of 2023, I did a LinkedIn post titled U.S. Debt Credit Quality Downgrade, ? And the base case scenario seems to be playing out. If this topic interests you, take a look at the post, and that, again, that's on LinkedIn, April of 2023, and marry it with these thoughts. I think you'll find it interesting. Frankly, there's risk everywhere, and sometimes it's staring you straight in the face. So on August 1st, credit rating agency Fitch downgraded the credit quality of U.S. government debt from AAA to AA+. And this is only the second time in history of our country that this has actually happened. The first occurrence was 2011 when Standard & Poor's made their credit quality downgrade. And I just wonder how long it'll be until Moody's, the sole holdout, still showing AAA, follows suit. There's risk of acceleration of this event by the pending potential September month-end government shutdown, as well as a looming potential for a long United Auto Workers strike. Now, both of those events could really impact our economy. Now, today, our national debt is, let's just call it 31 trillion. Now, hang on to this number. We're going to come back to this. And by the way, it's hard to pin that number down to be specific. Some sources will say we're at $33 trillion already. Others say 32. So I went with the lowest number, 31 trillion. Now, these are the three credit rating agencies and their respective ratings for our government debt. Moody's is the holdout at AAA. That's the highest possible credit rating for our government's debt. And Fitch and Standard & Poor's have both walked lower to AA+. Now, what's the so what on this topic? From my perspective, why the disparity? They're all looking at the same data. Why aren't they all lined up at the same rating? My thought, they probably should be and potentially will be soon. Debt to GDP is a commonly watched ratio. GDP is gross domestic production, and it's the value or the sum of the goods and services produced by a country. Taxation on GDP, well, that pays the country's bills. Let's take a look at the amount of national debt our country has had as of 10 years ago and where we are today. 2012, our country had 16 trillion of debt, and debt to GDP was 99%. And for kicks and giggles, source at the bottom of your screen. Now, in 2017, we had 20 trillion of debt, and that was 104% of GDP. Now, mind you, 25% increase in the debt load was offset by the increase in GDP. This is similar to a family with an increasing household income, and so potentially they sell the home, buy a newer, more expensive home, take on a little bit more debt. In 2022, here's where it got a little bit scary. Now, we're currently at around 31 trillion of debt, but 123% debt to GDP. Now, my point is not just that debt is rising, which is scary. Rather, what if from here going forward, GDP stops expanding and starts walking lower? Imagine if we have a moderate or a hard recession, what would happen then? Mark Twain once said, and I'm paraphrasing here, but he said, it's not the things that you don't know that will get you. It's the things you know for certain that just aren't true. Now imagine the following. What happens if mortgage rates go to 9%? What happens then? Earlier, I remarked about a speculative trade in place by hedge funds focused on the 10-year government bond. The URL for that article is on your screen. Ask yourself this question. Why? Why are hedge funds betting that the treasury market is going to move significantly lower in price, pushing yields higher? Is it possibly because they are speculating that the last holdout is going to also walk its credit rating lower and drop the AAA status? I think this is entirely possible. And let's take that one step further. In the fall of 1987, it was a scary time in the stock market. Let's take a look at what the bond market told us before that stock market correction actually happened. So, in other words, what was the bond market doing as of January, and what was the bond market doing as of October 1st, 1987? USTreasuryYieldCurve.com is a free resource anybody can use. This is where I pulled this screen print. And as you can see, that the short end of the curve, which is the left side of your screen, it moved higher by 1% from January of 87 to October 1st of 1987. The 10-year government bonds yield, well, it moved higher by 2.5%. We all remember Black Monday of 1987. That was a 25% drop in the stock market. Now, if hedge funds are lined up having placed the largest speculative trade on the 10-year government bond in the bond's history, and if our economy is potentially slowing, and if the credit quality of the bond was just downgraded as of August 1st, with one last agency yet to come lower, what are the implications there? Frankly, they're wide and far reaching. Here is one small theme to consider. Home lending rates are generally based on the yield of the 10-year government bond. So your typical 15 and 30-year fixed rate loan, they're tied to the yield on that bond. If the note's yield rises, what happens to the average mortgage and the affordability of a home and subsequent appraisals? Friends, these are deep waters with far-reaching implications. If you'd like to have a conversation with anybody in the investor relations team at Spartan by way of the securities that we issue and the risks therein, don't hesitate to track us down or give us a call. More than happy to have a conversation and talk with you about the risk. Thank you, ladies and gentlemen, for sticking in here and listening, and I'll catch you next time. Take care.